Hi, this is Keith Schneider, CEO of MarketGauge.com, and it's July 31st, 2022 edition of Market Outlook. So another powerful week with the market rallying strongly, putting in the best month since 2020. So let's take a look at where we are. One thing that's certainly interesting is you can see we had a important breakout above that 50-day moving average across the board, and we're getting some really good follow-through across all four indices. However, one caveat here is things may have gotten a bit rich. If you take a look at IWM on this rally, we're basically butting into some overhead resistance, but on terms of real motion and the Bollinger Bands, we're both outside of the upper bands, and meaning we're certainly ripe for a potential mean reversion. That doesn't mean things can't get more overextended, but if you take a look both in the Qs, you can see outside the Bollinger Band, and the same thing on price chart, and the same thing in real motion. S&P, same thing. So net, you've got a situation where 3 out of these 4 indices are definitely running rich, but certainly major improvement over the last week, and certainly over the last month. So net, remember, we're still under the 200-day moving average. Now, the other thing to note is that in the IWM and in the Qs, we're starting to get a slightly upsloped 50-day moving average, giving more credibility to this recovery phase, the breakout above the 50-day moving averages that occurred 2 weeks ago. And it also generated a buy signal in our alpha rotation trading model. All right, so as you can see, in much better shape, running rich though, so definitely move up stops if you participated in any of the upside, and make sure you're doing proper risk management. Okay, looking at one key intermarket relationship, what's interesting is that the S&P versus utilities actually lost ground. When I say lost ground, the S&P was actually weaker than utilities. Now, we're still sitting on a positive risk-on picture in the short term. In the longer term, you can see here that we're well beneath that longer term moving average of this ratio. And you can see this strength here and breakout into a bullish phase here in utilities, where we're still in this recovery phase in the S&P. So any further strength in XLU relative to the S&P will end up putting this particular ratio into a risk-off reading. At the moment, it's still hanging on to risk-on. So this is interesting because you would think this would have improved significantly with the huge rally in the S&P, but that has not occurred. Utilities have basically kept up with the S&P. Okay, now looking at volume analysis, one thing that's obvious is that this big rally here, and it has definitely flipped the picture in terms of positive volume days. So you can see accumulation days, 5 for the Dow, and across the board, more accumulation than distribution. Now, it's not a classic Zweig type upthrust, because this movement here took about 10 trading days, and actually the classic characteristic of a bullish reversal upthrust in volume took, I think, is about 11 days, and that has not actually happened. However, again, the bigger picture is that volume has definitely improved with this rally. And as you can see, Russells are now down 16% roughly on the year, 21% for NASDAQ, and the S&P down about 13%. So you still are in bear market territory in one of the most key benchmarks here, and things are still not in true bullish mode here. This is still a bad start, not a start, but a bad 6-7 months to the year, despite this huge 30-day rally and a big move for the month of July. Moving on to sector rotation, it's an interesting picture. We're getting a strong rally, but if you take a look here, energy still very strong. Actually, the strongest over the past week, up over 10%, up 41% year to date. So this strength in the energy sector, not good for the inflationary picture. So it's a bit confusing because interest rates themselves sort of stabilized, backed off, despite the fact that the Fed just raised another 0.75%, and yet the market seemed to shrug it off and seem to be indicating that the big jump in rates is over, or at least basically on pause. This has given a lot of energy to equities. So a couple things. Semiconductors, very strong, up 4.6%. However, what is disconcerting is if you take a look here, look at this retail sector. It was the only sector that was down over the last week. And of course, the retail sector is really a great indicator for the overall economy. And, if you take a look at the GDP over the last 2 quarters, it shrunk. So technically, we are in a recession. So not surprising to see retail the only sector that was down, while energy and utilities, risk-off sectors, were the strongest. But then you take a look, and another way to look at it is across the board, right? Almost all of our sectors were up, which is positive. They're all basically now in recovery phase, except for risk-off type sectors like energy and utilities. So, overall picture here definitely improved, but there's definite concern about this retail sector dragging as much as it has. And actually, if you look at it, year to date, the retail sector is down almost 30%, dragging the market down. So not surprising, again, with the yield curve indicating that we are in a recession and the GDP numbers confirming it. So moving on to what's hot or what's not, market hotspots here, more on a global basis. One huge theme this week is that clean energy and solar led the rally here. Solar up 18.78% for the last week, and so clean energy also up very strong. So alternative energy, clean energy, definitely catching a bid. Not surprising. Lots of pressure on these because classic energy, fossil fuel, also strong. You can see oil services also strong, but clean energy definitely getting some attention with this renewed strength and some speculation back in the markets. And of course, the other thing to note is issues in China. A lot of the Chinese stocks now could be delisted from the U.S., considering that they do not want to share their financial reporting to U.S. regulators. So big chance a whole bunch of Chinese stocks could be taken off of U.S. exchanges. Hence, lots of pressure, down 3% for China alone. That's quite the contrast from the U.S. equity markets, and equity markets just in general doing better. Even you can see here, for instance, Brazil up 11% plus over the last week, definitely improving quite a bit. All right, hope this all helps. As you can see, we're basically, at least on a short-term basis, on risk on. We still have, of course, the issue that markets are down, well under their declining 200-day moving averages, and it'll be interesting to see just how far they can take this, because there is lots of pressure on inflationary issues, and the fact is the Fed seems to be making a decision that the current rate, which is probably dragging under 5% what the actual inflation rate is remarkable. So tough decision with the Fed. Raise rates, cause even a deeper recession, or let inflation try to control itself, which could be a very iffy situation. All right, again, hope this helps. See you next week. Well, actually, I won't. I'm going to be on vacation, so the Market Gauge team will pick up for me, but I will be back in the saddle here mid to late August. So see you then, and have a great rest of the summer, and good luck with your trading, and bye for now.